Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Mihir Vora. What does he make of the macro combine, if you will, and how does he juxtapose both to try and figure out what is his view of what the global markets, the global macros, and indeed the local markets, therefore, could do? Mihir, great having you. Thanks for joining in. Hope all is well.
Absolutely. Good morning and good to be on the show with you.
Thank you so much, Mihir. Saal Mubarak at the onset. Let me try and understand if indeed this could be a Mubarak Samvat in that whether the narrative you think has changed from being a one which worried about inflation and interest rates to the one that is looking forward to peak rates and maybe a bit of a pull down in 2023 globally.
So these are very, funny times because on one hand, you have a situation where central banks are tightening because of inflation in a slowdown environment, which is something that we have rarely seen. Most of the times we have seen that interest rates and the markets go in the same direction. But this is the first time that we are actually seeing interest rates go up and markets having come down because the banks are fighting inflation. And that's a very unique situation. The developed world, especially, has not seen this situation in a long time. So I think this narrative about peak inflation, peak tightening, and all is kind of being manipulated or being used as a post facto explanation for market movements rather than a very scientific, analytical call. Because people just didn't realize how sharply the developed markets would fall, which they have. You've seen, the tech stocks like down 70%, 60%, a lot of them, and you've seen the S&P down 30% year to date. So while India has been relatively insulated, the developed markets really have taken the brunt. So to say that we are past peak inflation and past peak rate, it's probably a bit premature. And I think these narratives are being kind of used to explain recent market movements rather than a structured call.
Okay. Uh, Speaking of structured calls, here's the question. Sometime 2 weeks ago, me or maybe 4 weeks ago, when we did the Future Today Summit, one of the talking points was also that yeah, if indeed crude were to stay elevated due to supply side issues, or if China were to open up and that leads to a bit of a demand spike in this recessionary scenario, and with the rupee at whatever 83 or thereabouts, India will have an issue with the current account deficit. And that brings about an issue on the currency. And then it's a bit of a spiral that we get into until things stabilize. Now, and that might be negative for the markets as well. Now, I want to understand, does that argument hold water still? Does that argument hold water in general at all? Or do you reckon that the buoyancy of liquidity, which you had alluded to in the Twitter spaces that we've done with you, will kind of take care of this by and large?
So it depends on whether we, continue with the kind of Goldilocks scenario that we are in as a country, India as a country, or whether we go the other extreme. So if we have a scenario like you mentioned, where probably the narrative is shifting towards, maybe we have done too much globally in terms of tightening, and now probably let's wait and watch and see the impact of the previous tightenings before we take further calls. Then the Goldilocks scenario for India should continue, and we should hopefully not see further depreciation of the rupee. But if we go the other extreme, then there is a potential for risk of trade globally, global liquidity drying up dramatically, and then of course we would see further stress on the currency. So I think we are on the fine line. Import cover is down to like about 8 months, which is just about the bare minimum comfort level, and any movement on the other side can really tilt the favor against the rupee. Uh, what we have also seen is that as soon as India starts consuming more, when we say GDP growth happening, we've seen that there is a trade deficit. And as soon as we start consuming less, when there is a slowdown, the trade deficit reduces. So it clearly means that we are importing a lot of stuff even now, though the narrative is towards Atmanirbhar, we are exporting a lot more compared to earlier, but the imports are also quite sharp. So to that extent, I think it's a few years down the line before we become less and less dependent on imports. But for the time being, actually, the trade deficit is pro-cyclical. So, moment we grow, there's a trade deficit, and the rupee weakens. And the moment we stop growing, like we saw in 2020, 21, the rupee appreciated and the trade deficit reduced. So, there's a kind of a pro-cyclical bias towards how the rupee is managing, and that pro-cyclical deficit, which happens when the Indian economy starts to grow, is balanced by FDI flows and FII flows. So as long as we are in the situation where growth continues to happen, so we can run a slightly higher trade deficit, but FPI and FII flows continue, then we are okay. But if there's a global risk off, then there will be a problem.
Hmm. Okay, figures. Got it. So until that is clearly evident, I reckon you are saying that you would remain constructive Indian equities. We might be the most expensive place on earth, so to say, currently amongst the major markets, but still optimistic.
Definitely, because you do see earnings panning out. This quarter's earnings so far have been good. Even IT, where we expected some amount of margin compression to continue, seems to have demonstrated good margins. Banking is doing extremely well. I think banking will see a couple of more Goldilocks quarters where NII will grow, NI margins, net income margins will grow, net interest income will grow, NPA problems will not yet be visible. So to that extent, next couple of quarters look very good for banking also, which is the largest sector. So banking, IT, and consumption and infra spaces also do well. So to that extent, next 2-3 quarters look good in terms of overall growth scenario for India. And plus the huge narrative which is now building up, which is probably not showing up in FII and FDI flows yet, but the China plus one, and now on top of it, Europe plus one. That theme, coupled with defense exports and defense indigenization, can continue to give a good fillip to the Indian manufacturing base, which is what we need. So while services have been growing very well, services exports actually have been taking care of our trade deficit. The trade deficit is still pro growth. So moment we consume more, as I said, we have a higher trade deficit. But once we do a lot more things domestically, then even the trade deficit situation should improve dramatically. So I think we are in a sweet spot as of now.
Okay, okay. Mihir, interesting. I was looking at one of your tweets which mentioned that it's not just China plus one or Europe plus one. Japanese companies are looking at zero China. Now, my question is, in your because you obviously talk to so many large corporations and you attend so many conferences, etc., do you get a sense that Indian companies are grabbing these opportunities? Are global companies doing JVs or individual setups here? Because we know, so like we've seen the headline numbers, right? There's a Foxconn plant that is happening, there is something else that is happening in Gujarat, there's something else happening in certain other parts, in South India Tatas are doing this, mobile manufacturing, etc. So the headline numbers are happening. What about below the headlines?
So you're right. Yesterday also there's this big aircraft manufacturer which has announced 22,000 crores investment in Gujarat. It's huge. It's absolutely huge. Gujarat is also coming out to be a big hub for car manufacturing and exports. Down south we have electronics and auto components, and now even semiconductors, which is probably likely to come in somewhere in the south, or probably even Gujarat. Who knows? So the point is that these are happening, and I think the impact of this will be felt in the next 3 to 5 years, not very far. I'm not saying 10 years, probably 2 to 3 years we should see the impact of these things panning out. And that, coupled with huge ramp up in renewables, hopefully that should reduce our oil dependence also, means that gradually and structurally the current account situation should turn much better in the next 3 to 5 years.
Hmm. Okay. What about the near term here? I mean, sorry. Just before
And one
that,
more thing,
sorry,
one
yeah,
more thing.
please.
So we are. Sorry, I think you're breaking up, Neeraj.
No, please continue. Please continue, Mihir. Mihir, can you hear me? Mihir, can you hear me?
Yeah. So one more thing, Neeraj, I would like to mention is that the act of creating this infrastructure and manufacturing base itself will contribute to GDP growth. So while we are saying that all these manufacturing capacities will start contribute to GDP growth and trade deficit reduction in the next 3 to 5 years. But the fact that we are putting up these huge factories now, we are setting up these huge infrastructure to cater to these factories itself is creating a lot of activity. So we are talking about companies in the engineering, construction space, real estate space, capital goods companies, which will benefit now, and the trade deficit will be benefited in the next 3 to 5 years. So I think I won't say we are growing at the rate at which China grew in the 90s and 2000s as far as manufacturing is concerned. But even if we manage to do one third of that or one fourth of what they did in the last 20 years, it's big. It's really big.
Okay. Mihir, can you hear me now?
Yes, yes.
Okay, great. Mihir, what about the near term? The festive season, I heard you mention the results are thus far okay. Do you reckon India stands to have a strong chance at a stable Q3?
Looks like it. The only weak spot, as I see now, is in the rural economy. So if that continues to turn around gradually, then we should be in a good spot even in the third quarter. Though by Q4 FY23, which is the March 2023 quarter, you must also understand that GDP headline growth number will not look that great because of the higher base of last year. So by in March 23, we already saw very sharp GDP growth rate numbers. So March, as we exit FY23, which is the March 23 quarter, the headline GDP growth rate will not look that great, but the underlying strength continues, I think.
Got it. Okay. Um, yeah, Dabar's commentary laid out the fact that rural was looking slightly weak. It's happened with the other FMCG players too. I mean, what about banks? They were promising a lot. They've turned out doing even better, I thought, and that's a big weightage on the markets. What do you make of those numbers?
No, absolutely. The consumption story continues. So you do while you see retail credit, which was the key driver for the last 4 5 years, that continues. But now it's being added by corporate loans. So MSMEs as well as large corporates are beginning to now expand. And we must also realize that inflation also plays a big role in this. So when you have inflation of 10 15%, your inventory and the working capital requirement also goes up automatically by 10 15%, because that's the amount of value that you need to carry more because of inflation, if nothing else. That's one of the factors leading to credit growth, apart from the normal cyclical recovery. And the other thing to note is that the differential between some of the uh, bond yields which are traded in the secondary market compared to the credit had come down. So we are seeing a lot less issuances of corporate bonds, which probably means that companies are issuing less bonds and borrowing more directly from the banks because of the reduction in the attractiveness of bond spreads. So that's also one small factor contributing to credit growth, the shift from the bond market to the loan market.
Okay. So you are saying companies previously had that option of not going to banks but doing their own private issuances, and now they are shifting back to raising money from the banks or borrowing from banks.
Yeah, because what's happening is that the bond market has repriced higher very fast because interest rates have gone up, but the MCLR typically acts a bit slower because it's linked to the marginal cost. So the rise in the MCLR has been slower than the rise in the bond market yields. So to that extent, the bond markets are less attractive compared to MCLR. But I think in the next 2 quarters that'll correct again.
Okay. Me, the standout, I mean, PSUs by and large, yes, but can I first focus on PSU banks? They have been the standout performers in October. I was looking at the book values and they are very close to now what their averages have been in the past 5 years as well. What's happening with PSU banks? Why so much of fervor? Because they are always the bridesmaid, never the brides, quite to so to say, because they promise a lot but never quite deliver. Has something changed?
No, I think it's relative valuations. Frankly speaking, if you look at the structural buy and hold, which a bank or bunch of banks which you can buy and not do much trading in the next for the next 1 2 3 4 5 years, then it will still be private sector banks. Because the PSU banks, again, the issue remains continuity of management, accountability. Those issues will remain. So while private sector banks have done very well, there was always a catch-up trade to be done. Not only PSU banks, but if you see in the last few days, even the old generation private sector banks have also started moving. But that's, I think, just playing on the valuation differential gap rather than any structural change in management quality or business models.
Got it. And by virtue of you mentioning about defense, both indigenization and exports, which is also largely a PSU pack, but also some private sprinkling there. What's your sense? Again, companies are sounding very buoyant and the order books are looking good, Mihir. But the skeptics say that there is only one buyer, which is the government, and therefore B2G will not get premium valuations. Do you think this time around could be different?
So even if you assume normal margins, not extraordinary margins, the volume opportunity is huge. Whether the supplier is a defense public sector entity or a private sector entity, the sheer numbers are huge. And why are we forgetting the export opportunity, which is free pricing? So once you have a base, once you have economic scale, once you have size, you will be globally competitive because labor and manufacturing in India is competitive, right? So the not only the local market, which is just indigenization, but why are we forgetting the huge exports market?
Okay, actually, I hear that argument from some of the train sector companies as well, that the government orders have led them to now expand capacity and maybe they can really export too. So that could be pretty interesting. Before we wrap up, understand you have to go for meetings. To your mind, in the last somewhat or the last 9 months, what has been the most standout corporate feature? Is it, I mean, it could well be defense and the indigenization theme, but could be something else. What has stood out for you the most? I mean, maybe you didn't fathom this to happen and it happened and surprised you. Is there something that stood out for you?
A couple of things. One is the seriousness of defense indigenization and exports. And second surprise which has come, which probably has happened only because of Ukraine, is the Europe plus one. So we have, while we had China plus one, for which India was the beneficiary, but suddenly you are also talking about Europe plus one. And Europe again is the second largest manufacturing base in the world, right? So even if you have a little bit of capacity going out of Europe into other countries, including India, that's again a big mega trend. I think that's something that has surprised us, not probably yet on the ground in terms of numbers for India, but as a theme, that's one theme that has emerged, which is a surprise, a pleasant surprise, I would say.
Okay, so before we wrap up, what benefits there mean? I mean, is it specialty chemicals something that you've been constructive upon, or are there other themes that will benefit out of this potential Europe plus one benefit that could come into India?
No, it's everything, not only chemicals. Europe is probably the second largest car manufacturer in the world. All the cars are done there, and everything requires energy. So if you are saying that the cheap energy days are gone, then the whole manufacturing sector tends to get impacted.
Wow. Okay. Wow, maybe this is interesting. I understand you're short of time, so we'll let you go today. But maybe in about a couple of months' time, before the year end, if time permits, we could do a show with you on this whole Europe plus one theory and what could potentially come and benefit. It'll be lovely to talk about that.
Absolutely, it'll be my pleasure to do that.
Thanks, Mihir. Thanks so much for joining in today, and have a great Samvat.
Same to you, Neeraj. Take care. Bye.
Thank you so much. Viewers, thanks for tuning in.